Good afternoon, everybody. Happy Friday. I apologize. This is the latest I've done a Facebook Live since starting this process. Typically, I go on at 7:30 in the morning Pacific Coast time. Today, it's already almost noon, so I super apologize about coming late. It's been a busy day, including I hosted a live podcast this morning with Craig Davis on the shift in the mortgage industry. If you haven't seen it, check it out. It's pretty good. Craig is awesome, so check that out. But today, for my Facebook Live, I'm really excited about this topic, and I'm a little disappointed I'm doing it Friday afternoon because it's a big topic worth listening to. Okay, so here's the thing. I'm going to talk about fiscal dominance, and you probably haven't heard that term fiscal dominance before. And I am using data and content from RIA advisors, and as I said in my in the title, it's actually Michael Lebowitz from RIA Advisors or RIA Advice has a great newsletter, and from his most recent newsletter titled Fiscal Dominance. And I apologize because I'm going to read extensively from the newsletter, and I'm going to use data from the newsletter, and then I'm going to put it into context for mortgage and real estate professionals. Okay, so here's the deal. Here's what fiscal dominance means. Fiscal dominance is a condition whereby the annual debt of an economy reaches a point where monetary policy actions must follow federal debts and must allow federal debts and deficits to be serviced and funded cost effectively. Here's what that means, and I'm going to hint. What that says is that when a government starts to accumulate excess debt, the role of the banking system is to be able to make that debt digestible. That's what it means. And so what I'm going to talk about is what the Fed is going to be forced to do and how that's going to have a massive impact on real estate and mortgages. So stick with me. I'm going to go through some technical stuff, and then I'm going to try to convince you that this is here and that it's coming, and then I can tell you what to expect, and then maybe give you strategy on how to skate to the puck. And I believe this might be my most important Facebook to date, my most important Facebook Live to date. Now, I posted this article on my LinkedIn this morning. Check out my LinkedIn, check out Fiscal Dominance. I try to explain it in my post. I give you a link to the article, but hang with me, this is important stuff. So let's start by saying the debt to GPT ratio, it was approximately 97% in fiscal 2023. So our debt is nearly 100% our GDP, which is a problem. We already know that's a problem, right? But what the financial report of the United States government said is they expect it, if it continues to grow at the rate it is, it will be 531% of GDP by the end of the century. And that obviously is unsustainable. That's what the report says. It says specifically, this is unsustainable. So we have a problem, right? Our debt's at 100% GDP and it's exponentially increasing. Those are all really bad things, right? And now what happens is that the Fed will say their dual mandate, which is not managing federal debt, goes out the window completely because they're a slave to making sure the government is solvent, period, right? And now a concept to understand when we talk about this fiscal dominance is that, because we're going to talk about what the Fed's options are, right? I'm going to skip that for a second. We're going to talk about the options are, but here's the deal. The U.S. government added $2.5 trillion to debt over the last 4 quarters. $2.5 trillion of debt. Over $1 trillion of that was to help pay interest on the debt. So we took $2.5 trillion in debt, and then we used $1 trillion of it to pay interest on the debt. That's a giant problem, right? And here's the thing. That is despite really interest costs not going up. And here's what that means. Because the government finances their debt and longer term instruments, whether it's 2-year, 5-year, 10-year, right? that this last year and a half of interest rates going up, they haven't yet burdened that runoff, right? And so as those bonds mature, as the 2% bond matures or 1% bond matures, and now it goes into a 6% bond or a 5% bond, that's going to exponentially increase the cost of debt. But because those bonds haven't sold off yet, the actual aggregate interest rate paid on the debt in the United States has barely moved as an interest rate. So the aggregate, which is, by the way, the aggregate is 3.06. So super low. That's the aggregate interest paid today on U.S. debt. That's with new debt, previous debt, outstanding debt is 3.06. But even so, the payments, the monthly payments have dramatically risen because the debt has dramatically risen, right? The problem becomes as these bonds mature and they refinance into higher interest rates, right? And so I'm gonna give you an example. If most likely interest rate that the aggregate rate will be in the next 12 months is 4.75%, which means the interest expense will go up to nearly $2 trillion a year. Can you believe that? When all this bond rolls over to current rates, the carrying costs, the interest costs, will be somewhere between 1.75 and $2 trillion. That is crazy, right? And that doesn't count for additional debt. That's just carrying costs on current debt, right? And we know that we're still running a deficit, that we're running massive deficits, right? But if you were to say that the interest cost on the debt is going to go to $1.75 trillion just based on the trajectory of how bonds are refinancing to higher rates, that would mean that the interest payment is $300 billion higher than the next line item on the budget. It's $300 billion higher than Social Security. It's double the defense budget, right? Problem. That's a problem, right? Our interest on our debt is going to bankrupt us. And there's no candidate running that says we're going to cut spending. Both candidates are running to spend more. This isn't going to stop. The deficit, I mean, we're in a peace, booming economy, and we have record debt. That's only going to continue. So what happens? How does the U.S. afford the debt? Well, the argument on financial dominance is that the Fed intervenes and drives down interest rates to make the debt affordable. And so if the Fed was going to come in and if they were going to drive interest rates to 2020 rates, 2021 rates, the cost of interest would go down to $700 billion versus almost $2 trillion. So you see, and that's a big deal, right? And the Fed will have no choice but to drive that cost down. And so if you're a lender, right, or you're a real estate agent, what happened when rates got into the twos, the threes, the fours? I don't think they're going to the twos. I don't really think they're going to the threes. But if we believe in this theory of fiscal dominance, right? In the paper, in this article, the author cites all sorts of government studies that says this is exactly what they have to do, right? There's all these position papers that says this is exactly what's happening. So if we think that the Fed is highly motivated to drive down the cost of interest to help keep the government solvent, to keep this potential interest rate cost, to drive it down from almost $2 trillion a year to $700 billion a year, then you believe we're going to get back to low interest rates. And if you believe we're going to get back to low interest rates, what does that mean? What happened in 2020, 2021? We had massive housing transactions, refinance transactions. The velocity of sales, the velocity of money in real estate and mortgage just was pedal to the metal craziness, right? And so it's worth it to read this paper to learn what they're talking about, see if you believe it, become conversational on it, and then start to incorporate some of these concepts into your consulting conversations with your borrower, or if you're a C-suite, into your strategy about where your company needs to be in the future, right? And so, in this article, the author talks about, he has a section called "The Fed Understands Their Role." See that? The Fed understands the role. And it makes the argument why the Fed is 100% behind this and doing it. And it argues, hey, look, Brent Bernanke started QE, right, as a result to an emergency, and then the emergency passed and we still embrace QE. But that's not the part that really struck me. There in this, the author cites government provided forecasts, right? And the forecast that I pay attention to the most is what's going to happen with SOMA. And I don't know what SOMA means. You may or may not. That's the Fed system open market accounting. What it is SOMA is the Fed's holding, right? And so if you look at the Fed's projections of their SOMA, their holdings, right? Their projections are that their holdings are going to start to radically increase later this year. Radically increase, not a little bit, radically. That they're going to dramatically start buying bonds. Now, why do they buy bonds? Why do they buy treasury and mortgage? Why? To drive down the rate. It's to drive down the rate. They buy mortgages to drive down the long end of the curve. They buy treasuries to drive down the short end of the curve, right? And so if you look at the Treasury's prediction of SOMA, right, they see that, and I'm going to read right off this if I can find it. So the graph that they show, they show two graphs here. You can see them dramatically increasing right here, dramatically increasing, right? Two graphs. And here's what the Fed expects SOMA's account to rise by 40% starting in 2024. 40%. Can you imagine that? 40%. They already hold something like $6 trillion. Now, right now, they're selling it off, but they're going to reverse that, right? And what the Fed expects, this is a Fed chart, that we're going to start increasing SOMA. So if you believe that, then you believe the Fed has a longer-term strategy of driving down rates. As soon as they can contain inflation, they need to drive down rates. Now, between inflation and rates, they need to help the government. They would definitely stick, the economy with inflation over having this debt service of $2 trillion a year. I mean, they're both are bad choices, but trust me, they will drive down rates and not worry about inflation if it comes to that. Because, by the way, inflation is a way you can inflation away your deficit. And so you're definitely going to see that. Now, this brings up another really interesting concept, one that I've talked about before and I love. The Fed doesn't set interest rates, right? Because I'm the Fed. I go, look, the United States can't afford $2 trillion in debt interest payments a year. I'm going to drive rates down to where it gets to $700 billion. I'm going to drive rates down at the Treasury. Let's say I'm going to drive down the 2-year Treasury to 2%, whatever, 3%, right? I'm going to drive it down. Did they set the rate? No, they didn't set the rate. That's a target. Who sets the rate is the participant that buys the bond, right? And I'm not going to buy the bond at 2%. I don't care what the Fed says. Because at the lower rates, like we've seen the last 20 years, it has a negative yield. If you take interest rate minus CPI, that gives you the true yield, roughly, right? And so banks, hedge funds, nations aren't going to invest trillions of dollars into a negative yield. And so there's a flaw in this fiscal dominance, right? The flaw is that, the Fed can't control rate. They can't control it at all. So how then is this going to happen? How do they see? One, they can buy it themselves. Like we said, they're going to increase their portfolio by 40%. That demand right there will water down the cost of supply. Right? More demand, the higher demand, the less cost. The less demand, the higher cost. So one, they're going to buy. But this is what's fascinating in this article, and I love it. In this article, is they're going to use monetary policy to help drive rates down, and this is fascinating. And you can read the article. I'm just going to give you the Reader's Digest version. They're going to force banks to buy treasuries, and you go, how do they do that? Well, they can do that by Basel III. They can do that. What they do is they're changing the rules of collateral, forcing banks to have more collateral, and essentially the proposal is banks need to have collateral, 40% collateral for uninsured deposits, right? So any deposit that's not insured, it's over the maximal insurable amount, the bank has to hold 40% collateral. So let's say you have $10 million in uninsured deposits. That means you have to have $4 million in collateral. That's what that means, right? It's pretty easy to understand. So they force the banks to have higher collateral, right? And Basel III is about more collateral, right? The new uninsured deposits, 40% collateral, they force them to have more collateral. And then what do? What do banks do? Banks can't hold their collateral in cash, right? Because cash is depreciating. If they, an example where they have to hold $4 million in collateral, and by the end of the year, that $4 million is worth 3.996, they just lost money. And so what most banks do is they put their collateral into treasuries, right? And what the regulators will say is if you invest in treasuries, it's dollar for dollar. Where if you put your collateral, if you use other types of collateral, it's a risk, and so it's not dollar for dollar. Like if you put mortgages up, depending on what kind of tranche of mortgages is, it might be valued $2 for every three you have in collateral. But if you buy treasuries, it's dollar for dollar, or it might even be a multiple, right? And so one, they're going to force banks to hold more collateral, and then they're going to entice banks to hold that collateral in treasuries, which will help them then absorb all the treasuries they have to sell and drive down the interest rate. Fascinating, right? Really fascinating. So the Fed thinks they're going to increase their holdings by 40%. They're going to force banks to buy more treasuries, and they're going to drive interest rates down to make the burden of interest payments on the debt manageable for the U.S. government. Seems believable to me. Very believable. And this is a financial paper. This I'm not talking politics. This isn't Democrat or Republican. This is just fiscal policy. And so I think we should all be aware of what fiscal dominance means, right? And if this makes sense to you, if you read articles like this, if you study this, right, and you believe it, you believe the Fed when it says it's going to increase its SOMO holdings by 40%. If you believe the Fed when it says it's going to change the collateral requirements for banks, right? If you believe that, which seems pretty believable to me right now, then you believe the Fed is going to drive interest rates down. Now they're trying to hold off until they get inflation in check. And by the way, debt becomes a drag on the economy. And so it will be counter-inflationary at some point as it grinds the economy to a halt. But the other thing that it does is that as they drive interest down, it pumps a ton of liquidity into the economy, which really drives velocity. And that liquidity helps mortgage and real estate. And so if you read this, you could believe that, hey, you know, good times are coming again soon, that we're going to see a radically low interest rate environment. You know, we said we never see interest rates in the four again. I'm not so sure. I'm not so sure that next year we don't see rates next year or in 2026 we see rates in the four, maybe even into the threes as the Fed comes to the government's, rescue in driving down interest rates costs. And so if I was a futurist, if I was a strategist, I would be telling companies, hey, you got to be building, loan officers, real estate agents, you got to be building funnels to capture all this business is going to come. You have to start building really efficient assembly lines so that you can take on massive amounts of volume, and that you have to build an expense structure that makes it exceptionally low cost so that you can compete in what's going to be a really thin margin. Because one of the things that will happen, I keep saying this, we're not going to see inflated margins because of cash capacity. In 2020, 2021, margins inflated as a defense to having no capacity, right? I mean, most lenders, they got up to 30, 60, 90 days in underwriting. We didn't have capacity, so they managed it by raising rates. They try to slow down the velocity of business so that they could digest it. That's not going to happen this time. The way that technology platforms have been built out, these big companies are going to be able to absolutely have the elasticity to gorge themselves on unbelievable volume. I listened, which I'm going to talk about next week, I listened to the CIO of United Wholesale Mortgage do a keynote for an hour on the technology that United Wholesale Mortgage has built in the background. And trust me when I say they are committed to sticking to a 10 to 14-day turn time on every loan, regardless of the circumstances of the market or where interest rates are or volume. That they are going to just hammer it. And they're not the only ones. There's plenty of companies doing the same thing. And so we're not going to see giant margins because of capacity constraints. And if you're, in my opinion, if you're a CEO and that's your strategy, hey, Ron, I agree. Interest rates are going down. Boom times are coming. I can just be inefficient. I can have all these expenses. Don't worry, because my competitors are going to have margin or capacity constraints, and that's going to help us all increase the margin, which is going to save my company, save myself. No. Just hear me. No. But that doesn't mean that we can't plan for a massive opportunity of business sometime, the next 18 months, 24 months, and that we can't build the platform to build the conveyor belt, build the manufacturing plant, knowing that it's coming. What happens is, if we believe this, we can build with confidence. Because right now, owner might go, look, I don't want to spend millions building out my fulfillment, building my technology, going low cost. I don't want to make those investments because I'm not sure if I'm ever going to, reap the benefit. I'm telling you, you could reap the benefit in volume, but you have to build efficient, low cost, highly effective stuff today, or else you're going to just really have a challenging uphill. So check out this article. I love this article. It's so good. Fiscal dominance. See what you think. Thank you for checking me out. Thanks for coming on my live or checking out my live. Thank you if you checked out the live podcast earlier today. I'll be live over the weekend. Hopefully you're doing fun stuff. If you can check me out anytime. Tomorrow is news and notes from the week. I got about 20 articles. I'll do a 5-second overview on each one. And then Sunday, Book Club Sunday. That's it. Hope you have a good Friday. Have a great weekend. Thank you. Bye.